Imagine two people. Same age, same income, same city. One of them opened a brokerage account a decade ago, picked a simple ETF, and started his journey to financial freedom. The other kept saying they'd start investing when things calmed down. When the market dipped, they waited. When inflation hit, they waited. When headlines got scary, they waited some more. Today, the first person is sitting on a life-changing sum of money while the second person is still waiting. That gap between them isn't talent, it isn't connections. It's one decision, made once and then left alone to grow. In this video, I will break down 5 exceptional ETFs that have been tested by real market conditions. They have survived crashes and consistently recovered from the corrections. I will demonstrate how 2 of these unique ETFs can yield portfolio values of over $2 million and $3.5 million, starting with just a $10,000 lump sum and a weekly contribution of $70. If your ultimate goal is true financial freedom, this is the video you do not want to miss. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, here's the thing nobody talks about openly enough. The financial pressure most Americans are feeling right now is real, and it is not in your head. Inflation has quietly eaten through the purchasing power of the dollar in ways that feel almost personal. A trip to the grocery store that used to cost $150 now runs $220 for the same cart of food. Your rent has probably gone up, your car insurance went up, your utilities went up, and somehow your paycheck is doing its best impression of standing completely still. At the same time, the job market has shifted in ways that would have seemed unthinkable just 5 years ago. People with degrees, experience, and strong resumes are sending out dozens of applications and receiving automated rejection emails. Entire industries that felt stable are restructuring. Layoffs that used to make headlines now barely get noticed. The old playbook, go to school, get a good job, save a little, retire comfortably, has developed some serious cracks. What makes this even harder is its emotional weight. There's a specific kind of stress that comes from working hard and still feeling like you're falling behind. It's exhausting in a way that's difficult to explain to someone who hasn't lived it. And that exhaustion makes people vulnerable to 2 dangerous reactions. The first is avoiding the topic of money altogether because it feels too overwhelming. The second is chasing shortcuts, jumping into meme stocks, crypto hype cycles, and whatever is trending on social media this week, hoping something will finally change the math. Both of those paths lead nowhere worthwhile. What actually works is boring by comparison. It's systematic, patient, and built on real data. Let's get into it. Coming in at the 5th position on our list is the Vanguard Total World Stock ETF, ticker symbol VT. Think about how much mental energy the average person wastes trying to guess what's coming next in the market. Is it Europe's turn to surge? Will China slow down? Should you shift toward emerging markets? These are questions that professional fund managers with research teams and decades of experience still get wrong all the time. VT eliminates those questions entirely. VT has delivered a 10-year average annual return of 11.93% by doing something that sounds almost too simple. It owns everything, more than 9,000 companies across developed and emerging markets worldwide, with Nvidia, Apple, Microsoft, and Amazon sitting near the top of the list. When the US has a rough quarter, other markets often pick up the slack. When one sector struggles, another rises. You stop trying to predict the future and start participating in it all simultaneously. There's a psychological relief in that which is hard to put a price on. In a time when uncertainty feels like the only certainty, VT lets you stop fighting the global economy and start owning it instead. Coming up at the 4th position is the Schwab US Dividend Equity ETF, ticker symbol SCHD. Here's a question worth sitting with. What if your investments started sending you a paycheck that could immediately cover your monthly bills and commitments? That's essentially what SCHD does, with a 10-year average annual return of 12.23%. SCHD holds high-quality U.S. companies like Chevron, ConocoPhillips, and Merck, businesses that have not just paid dividends for years, but have consistently increased them. This becomes a fundamentally different relationship with your money. Most people think about investing as something that rewards you at the end, somewhere far off in the future. SCHD introduces a current reward in the form of dividend income that compounds over time. In an environment where inflation is making everyday life more expensive and paychecks are stretched thin, there's something deeply motivating about watching your portfolio generate income without you having to do anything extra. It also does something powerful to your behavior as an investor. When you see real cash flowing from your investments, you're far less likely to panic and sell during a market dip. That emotional anchor is worth as much as the returns themselves. SCHD won't show up on anyone's most exciting ETF list, but for building genuine, lasting financial stability, it belongs in the conversation. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Coming up next is the Vanguard Total Stock Market ETF, ticker symbol VTI. Let's start with the fact that critics of the US economy aren't completely wrong about the challenges. Inflation has been stubborn. The wealth gap is widening. Certain industries are contracting. But here's what the pessimistic narrative often misses. Underneath all of that, new companies are being founded every single day. Technologies are being developed that will reshape industries we barely understand yet. Entrepreneurs are solving problems that haven't been fully articulated. That engine doesn't stop running just because the headlines are grim. VTI captures all of it. With a 10-year average annual return of 14.66%, VTI holds thousands of companies across all sizes and sectors in the American market. Yes, that includes the giants like Nvidia, Apple, Microsoft, and Amazon. But it also includes the mid-sized companies growing fast and the smaller companies that could become tomorrow's household names. You don't need to identify which startup will win. You don't need to time when small-cap stocks will outperform large ones. VTI removes all of that complexity and replaces it with something simple. Own the American economy in its entirety and trust that, over time, human ingenuity and economic adaptation will drive it forward. History has supported that bet over and over again. Next on our list is the Vanguard S&P 500 ETF. Ticker symbol VOO, I call it the self-cleaning portfolio. Here's something most investors never figure out until it's too late. The hardest part of investing isn't buying. It's knowing when to sell. Knowing when a company you believed in has peaked. Knowing when to cut your losses. Knowing when the story has changed. That skill requires emotional detachment that almost nobody actually has when real money is on the line. The Vanguard S&P 500 ETF, known as VOO, solves that problem at a structural level. With a 10-year average annual return of 15.26%, VOO tracks the 500 largest companies in the US, but what makes it genuinely elegant is that it continuously removes underperformers and replaces them with stronger companies. The portfolio cleans itself. Companies that lose relevance get pushed out. Companies that earn their place rise to the top. Its biggest holdings include Nvidia, Apple, Microsoft, and Amazon. Names that didn't always hold those positions. They earned them by delivering results, and VOO was right there to capture that entire journey. For anyone who has ever held on to a losing stock too long because they couldn't bring themselves to sell, VOO is the antidote. It makes the hard decision automatically, every single time, without hesitation or emotion. Now let's demonstrate what the projections for this unique ETF can look like after 10, 20, and 30 years. To project its future value, we'll use a standard compound growth formula that combines two components working simultaneously. The first component is the lump sum investment. It will be calculated using the future value formula, where the future value equals the principal multiplied by the quantity of 1 plus the interest rate, raised to the power of time. In this equation, P is the initial $10,000, R is the annual return, and T is the number of years. The second component is the weekly contribution, which is treated as a series of payments. It is calculated using periodic payment future value formula, where the future value equals the periodic payment amount multiplied by the quantity of 1 plus the interest rate divided by the number of compounding periods per year raised to the power of the number of compounding periods per year multiplied by the number of years minus 1, all divided by the interest rate divided by the number of compounding periods per year, where PMT is $70, N is 52 weeks, and the return is applied weekly. These two values are then added together to get the total portfolio value, with VOO compounding at a 10-year average annual return of 15.26% at the 10-year mark. The $10,000 lump sum starting point and $70 weekly contribution will grow to approximately $125,000. That's already outpacing nearly every traditional bank savings strategy. At the 20-year mark, that number will grow dramatically to approximately $521,983. Driven by 500 of the most battle-tested companies on the planet, businesses that earned their position by outperforming everything around them. Then, at the 30-year mark, the portfolio would be worth approximately $2,041,876. No guesswork, no emotional decisions, no second-guessing yourself through every market swing. Just a self-correcting, performance-driven portfolio doing exactly what it was designed to do over time. I know this is fascinating, but you need to see what can happen when a fund stops playing it safe and starts chasing pure momentum instead. Coming at the top of our list is the Invesco S&P 500 Momentum ETF, ticker symbol SPMO. There's a concept in psychology called social proof, the idea that when we see a lot of people moving in the same direction, we assume they know something we don't. In financial markets, that same force drives what investors call momentum. When a stock or sector starts performing exceptionally well, capital flows toward it, driving it even higher and attracting more capital. It becomes self-reinforcing, at least for a period of time. Most investors experience this phenomenon from the outside, watching something run without them. The Invesco S&P 500 Momentum ETF, known as SPMO, builds that observation into a systematic strategy. With a 10-year average annual return of 18.51%, SPMO doesn't try to guess which companies will perform well in the future. It identifies those already performing well and holds them while the trend continues. Its top holdings include Nvidia, Broadcom, Johnson & Johnson, and Micron Technology, and the portfolio rebalances periodically to stay aligned with whatever is showing the strongest momentum. This is not chasing hype. It's a disciplined pattern recognition built into an index structure for investors who want to capture growth that's already in motion without spending every evening analyzing earnings reports. SPMO does the heavy lifting in a way that's repeatable and historically effective. Now let's dive into the numbers. With SPMO running at an 18.51% average annual return, that same $10,000 initial lump sum investment and $70 a week starts growing at a pace that begins to feel almost unreasonable. By year 10, the portfolio will expand to approximately $150,000. But year 20 is where momentum investing starts to reveal its true character, pushing the portfolio to roughly $756,418. That's not a gradual climb anymore. That's acceleration, driven by a fund that systematically positions itself behind the strongest market trends and holds on while they run. Next is my favorite, the 30-year mark. That is when this unique ETF will deliver a number that reframes the entire conversation, a whopping $3,587,642, all from a single one-time lump sum of $10,000 and a $70 weekly investment. Think about this for a moment. Over $3.5 million. This confirms the common saying that momentum rewards patience. Now, let's go back to those two people at the beginning, because what separates them isn't knowledge, it's the decision they took. One invested despite everything, while the second person waited for the perfect time that never came. The financial landscape in the US is genuinely difficult right now. That part is not a mindset problem. The costs are real, the pressures are real, but difficulty is not the same as impossibility. And the people who recognize that the worst time to feel financially comfortable is often the most important time to begin building are the ones who look back a decade from now with an entirely different story. Time will pass either way. The market will keep moving. The question is whether you'll be inside it when it does. Start now, adjust as you go, and let time do what it has always done. Now, if you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Listen, if you want to know the 5 best Fidelity index funds to buy and hold for life, or the 5 best high-yield ETFs for monthly dividends with zero NAV erosion, check out the videos on your screen right now. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Thank you, my friend.